Well, hey everybody, good morning. Thank you for hanging out. I really appreciate all you guys coming out here today. It truly means the world to always see so many people come out to these events. I know you guys have so many other places you can be, and that you come repeatedly. It makes me think you guys are actually getting something out of it. So so we appreciate that. It's put a lot into it, and it means the world to us. So thank you guys. So one of the things that you guys have asked for, we've been doing surveys at the end of every lunch and learn series here that we're doing, and everybody's kind of given ideas. And one of the things that a lot of people have asked for, there's a lot of new agents these days in our county now, and Joe's probably the newest agent. I think he was licensed last Thursday. Okay. So you've been a real estate agent for a week. How many deals have you put under contract?
Not yet.
Okay. So,
and who are you with, Joe? Who are you with?
I'm with Remax Country.
cool. So, Joe, will you tell us a little bit about yourself, and then what we'll do is we'll kind of continue from there. And if everybody could just say their name, who they're with, and then just a fun fact about themselves, that'd be awesome. Okay, Joe, you're up first. Fun fact.
Hi everyone, I'm Joe. I'm with Remax. It's been, like Adam said, about a week of me being licensed, which the entirety I spent being sick, so I'll be glad to get out of that. Previous experience in sales and business management and marketing, so it'll be good. I wanted to try this, and so far it seems very exciting, and I think I'm going to enjoy it.
Awesome. Glad to have you.
Thank you. Glad to be here.
Yeah, Jim Jock, Remax North Country. Fun fact, trying to do more videos on social media.
I'm Lisa LaFleur, because she's 21, and my fun fact is I like to have fun.
Oh. How about you?
Cameron Corretti, there's the Remax, and as I look around the room, I'm probably the oldest one here in the real estate business. I'm in my 30th year.
Awesome.
I mean, I've been in real estate longer. I don't know who's older. You were hiding behind it.
It's so long here, nobody knows.
I know. Going back to you.
You guys have Florida.
She helped me buy my house way back then.
Yeah.
Judy Guglielmo, Staff Realty, 18 years doing it, love the business, but I'd rather paint.
Cool. Ella?
Ellen Welch from That Coast Realty. Fun fact might be, I don't know about it. I'm kind of addicted to yard sales and repurposing.
Cool.
Actually, I think I've seen you go to garage sale.
Pardon?
I think I saw you go to garage sale.
I've gotten a few listings.
Yeah, there you go. Good sales guy.
Steve Brissett with a real estate group, and fun fact is I think I'm older than Bo, Tammy, and no, definitely not older than you. I'm sorry. Also older, much older than you.
Loretta Campiello, I'm with Newly Associates, 11 years. Fun fact, okay, I've been playing the piano, learning lessons in the last year.
Oh, cool. Very neat.
Yeah.
My name is Brad Phillips. I've been on Newland Associates just under a year. And the fun fact is I run a co-ed dog road roof every Friday 9 to midnight.
Cool.
9 to midnight.
You can dodge the ball, you can dodge the rest, right?
I'm Evelyn O'Hara-Boucher, Remax North Country. Doing this just under a year. And fun fact, I guess, would be I used to do ballet. I did that for about 12 years.
Still my fun fact.
Michelle?
I'm attempting to do the 46 by the time I'm 46, so I've got 6 years.
Well, you got,
How many are you on?
3.
Michelle's not going to be doing much real estate next time.
Everybody does it.
My name is Lindsay Polaris. I work for Coldwell Bakers. This is my 3rd year. And fun fact is I'm a beekeeper.
cool. Have
You ever let him go?
Associates? Fun fact, I don't have a middle name. There you go. Middle name? I don't have a middle name.
I don't have a middle name?
Nope.
Well, let's give you one.
Shark.
I use one, but it's not my real.
James Archambault, Keller Williams Real Estate, about 4 years. And no real fun facts. I have a rescue dog named Benny. Who's,
You gotta think of those fun facts.
who I spend all my time with every day.
Garrett Hemingway, Keller Williams, over the years. I slay unicorns. I have no idea.
Slay unicorns, huh?
Can't sell me anywhere.
Yeah.
Yeah, that's what I'm getting. Crazy choice.
Alan Jackson with Keller Williams. I've been with him for under a year, and Jim and I are ice dancing partners.
I had to do something after ballet. The girls are
I'm Chris Dooley of Dooley Associates, and my fun fact is that this weekend my plans involve skiing, so I'm disappointed we only got 2 days.
Where are you going?
White Base.
There you go.
Mike Ralph, Keller Williams, and I'm extremely overwinter.
David. Ryan Barcombe with Keller Williams, been in real estate for a year now. And, fun fact. Adam was really excited over the weekend that he found out I'm an above average bowler.
He came in with his duffel bag, and I was totally making fun of him. And then he actually could bowl, and I was like, all right. My name is Adam Crosley, over at Advisors Mortgage Group, and fun fact, on that theme, I actually was an ice skater. Throughout high school, I brought a picture to show them the other day. I was like 12.
You mean like the whole tights and everything, you know? Sequins and
It'll be
everything?
on Facebook later today.
I'm not getting
The
into
pose was something like this, you know? Nicole?
No way, we didn't.
Oh, no.
Stand up and introduce yourself.
Nicole Hero Dutil. I work at Advisors Mortgage. I don't know, my fun fact is my dog does have a middle name. Bailey Bledsoe. Yeah, Future Bledsoe. He was like my absolute love when I was in college. Quarterback, Adam, never mind, you won't know. Adam knows nothing on sports.
Another fun fact.
Another fun fact, not a sport guy.
Hi, I'm Taylor. I'm Adam's intern this semester. I go to Plattsburgh, and my fun fact, I'm graduating in May.
Heather Snyder, works with Adam Advisors. My fun fact is I'm an avid Packers fan, so.
She has a little stapler.
Yeah.
But day one, she comes in, she's like, it's cool if I bring this.
He didn't know it was.
Awesome. Cool. So today we're going to kind of teach mortgage basics. That's one of the things that a lot of people have said that they really want to learn. So, I have a presentation, but I also wanted to it's a smaller presentation. When I was preparing for this, I've talked to a few of you guys over the last week or two just to kind of get ideas for it and different things. And what I realized is everybody wanted to know different things about mortgage and had different mortgage questions. So I have something prepared. I'm going to kind of go off that very loosely. But what I want this to be is more of a conversation. I want to answer all of your mortgage questions that you guys have. Because basically, in talking with 5 or 7 people in the last week or two, everybody has different questions on mortgages, everything from appraisals to specifics about, different things. What I don't want today to be is I don't want you guys to become an underwriter. I don't want you to be able to pre-qualify people. I don't want you to, leave here trying to, be a loan officer, because earnestly, the guidelines are thousands and thousands of pages, and there's things in there that you're not going to know until you really study this. So I don't want that to be this. Does that make sense? Cool. So kind of starting from there, there's, let me get out of this. Better? We can see the screen. So really the basics of all lending runs on the 4 C's. Heather, would you hit the slide twice? And those 4 C's, capacity, collateral, credit, and capital. Okay. And has anybody heard of the 4 C's before? Okay, so we have a few people. So capacity really comes down to debt to income. And what is the person's debt to income and how much can they afford? And there's 2 debt to income ratios. There's the front end ratio, which is they take the person's income and we divide it by the proposed house that they are looking at. Then there's the back end ratio, which is we take that person's income and we divide it by the proposed house plus their current debt load. And for every different program, that max debt to income for both of those numbers is completely different. And every lender is going to have different things. So I'm not going to go specifically by what I can do today. I'm going to go by program guidelines. So that way when you're talking to other lenders, I can, obviously talk a little bit better about what I specifically do. But I will talk about program guidelines today, so you guys have a general view of how that. Capital is obviously cash to close. How much cash does the borrower have in their retirement account, checking savings, if they have any cash value, 401k, anything, even if we're not utilizing that as far as the mortgage, they're called reserves. So if the customer had to sell everything, liquidate everything, and had more reserves, that paints a prettier picture to any lender of how strong that borrower is. So that's capital. Collateral, anybody know what collateral is? The home, exactly. And obviously the homes can have appraisal issues depending on certain things. Obviously it needs to appraise for value. But we're going to talk a little bit about that. And then credit. And credit is somebody's credit score. Unless we're doing a manual, untraditional, and building credit for somebody. But those are basically the 4 C's of lending, when we're looking at everything. When it goes into individual guidelines and individual programs, those change a lot. So I guess with that kind of said, do you guys have any questions on that? No? Okay, cool. So the next I wanted to start talking about individual type programs. So I guess before I do that, let's kind of start with what do you guys want to get out of it? Like, for me to teach a good class, if you guys have, say, left saying this was an awesome thing, I need you to learn things. What do you guys want to learn by the end of this class today? Jeff?
What do you do if they don't qualify?
If they don't qualify?
Yeah.
Okay, cool.
Good question.
Okay, what else? I was going to give you a class. Everybody's getting the soup buffet or everybody else. Okay.
What program can my buyer use if they're dead set on a double wide?
Okay, double wide. Come on.
And do you offer that anymore?
Yes.
Or you are now offering double wides again? Yeah. Don't. Hello.
Okay, what else?
That was a no-brainer.
Maybe advice on how we can tell our clients about how to apply and what they should do to be ready to apply.
Okay. What else?
How is the interest rate determined upon buyers?
How is interest rate determined? Any other questions? Anything else you want to learn about mortgages?
Maybe the role that the appraiser plays,
Okay.
not just for value, but this specifically is for condition and where you see that going.
That's a good question.
Anybody else?
What about like comparing a bank versus a mortgage company versus a credit union?
Cool.
That's a really good one, Michelle.
Awesome.
Oh, perfect, perfect.
Give you my unbiased answer.
Probably end on that one.
What is your expectation of time frame to close now?
Time frame to close? It really depends on type, is ultimately, but, I mean, cool. What other questions do we have?
We were just discussing the 203K again. Can
Yep.
you just like go like abbreviated version of the process for us?
Does everybody have a phone on you?
Yeah.
Pull out your phone. Okay. Open up your calendar. Okay.
Yeah.
Write down May 16th at noon in this room.
May 16th at noon.
We'll learn a lot about 203K.
Okay, never mind.
We'll talk in text a little bit.
That's all right.
Jim Reagan is going to come back up here. Since we've rolled out the 203K program, we have done more renovation loans than any other branch in the company because there's a lot of dated inventory. So he's going to come back up. We're going to teach a lot about that. And then we can jump into any 203K specific questions here later today as well. Side note on 203Ks, one of the issues that we've had is with our consultant, and as of this week, we have a new HUD consultant licensed for Clinton County as well. So that'll alleviate a lot of our issues with those. So cool. So let's kind of I'll kind of do both of these things, and we'll work in, and I'll try and work some of these questions in. Any other questions we want to talk about? No? Okay. If you do, let's kind of going forward the rest of the class, just raise your hand, and we'll just kind of have a conversation about everything as well. Okay? There's a lot of information, a lot of basics, but I think it'll all be pretty good stuff for you. Okay. Got it? So conventional loans. Who's done a conventional loan before? Pretty much everybody, right? That's the lion's share of loans out there. So most conventional loans are going to be they always work out to be for your best credit borrowers. You can do a conventional loan with as little as 3% down. And I'm talking kind of from here on out, I'm going to be talking about our guidelines and kind of program guidelines, and I'll touch base when that is. But Fannie Mae allows you to go with a 3% down with a conventional loan. Most lenders don't do 3% down because it usually doesn't make sense for the customer. Because if you have an FHA product, that FHA product, unless the house doesn't qualify, is usually going to be a better financial decision for the customer. Because if you're putting 5% down versus 3% down, the extra cost in the interest rate and the extra cost associated with mortgage insurance is a lot higher. So you might be spending about extra $100 a month to put 3% down conventional, where if you went FHA with a lower credit, or even with a lower credit score, your payment at the end of the day is going to be a lot less. So usually that makes sense. So,
But you'll never get rid of PMI. Yeah.
FHA, correct. You won't get rid of PMI on FHA until you refinance out of it. But the other side of that coin is if you go with a 3% loan and you're making your minimum monthly payments, you're not going to get to a point that's a 78% loan to value until you're 10.5. So most buyers are going to either sell or refinance within that first 10.5 years anyway. So yes, that is correct, but the statistics show it's like it's almost like 90% of people within the first 10 years are in a different mortgage 10 years later. So it is a point, but to get into the property, when you look at those side by side, the FHA typically makes more sense. And again, unless the house is not qualified for FHA. So you do have to have PMI with conventional. We're going to be teaching a class. I'm trying to get a PMI rep to come up here. That's not as easy as getting a renovation guy to come up here. I'm trying to get a PMI rep to actually come up here later this year to literally just give you guys a whole education on mortgage insurance, a lot more than I can talk to. So that's something that I'm working on right now. Is everybody familiar with PMI? Okay, cool. Does everybody understand essentially what mortgage insurance is? So essentially, back in the 40s and 50s, there wasn't mortgage insurance. Everybody put 20% down on a house. And then all these programs, the mortgage insurance was created so that way when a borrower could put less than 20% down, and the programs kind of followed in through it behind it. Because, God forbid a family loses their job or whatever, and they do have to go through a foreclosure, that bank is going to lose some money. And that mortgage insurance covers them to about 20%, and that's the whole reasoning for mortgage insurance. In today's day and age, there's actually, a lot of lenders don't talk about this, but people just think there's a flat rate of PMI. And with a conventional loan, that's not the case at all. If you have a lower credit score person with PMI, PMI is all risk-based. So if you have somebody under a 700 credit score, the cost of their mortgage insurance is very high. Mike had a customer, we were doing that scenario like a month or so ago, and we ran on somebody with PMI with a 660 versus FHA, and their payment was $150 more a month. Because PMI is all risk-based. You go, again, you get a low credit score person. Conventional doesn't always make the most sense for him. Let's say I'm talking with a guy right now, he doesn't really want to put 20% down because the house needs some renovation work, but he doesn't really want to have that PMI out of it either. So you can actually do what's called an upfront PMI. A lot of lenders don't even talk about that. And essentially you can figure out what the total cost of that mortgage insurance would be is if you kept that for up until that 20%, and you could pay it all at once at the closing table, and that actually lowers that total cost down to about 30% of what he would pay over the course of the next 10 years. So it's called upfront PMI.
So you get a discount because you're paying it up front?
Right, you're paying it all at once. And most people don't even talk about that. But yeah, if you're willing to pay it all up front, increase your closing costs essentially, you can do that. Another thing that you can do, this doesn't make sense, but I think with where our current rate environment's going, we might see more of this, is what's called lender-paid PMI. Is anybody familiar with, anybody know that a lender can actually get a PMI? No. Cool. So the lender can actually pay the PMI. So essentially what they do is, after the Frank-Dodd Act, the Frank-Dodd Act said that all banks really offer the same thing, and then all the same rates, and banks used to make money on the back end. They can't anymore. They have to give it all back to the customer. So what we can do is we can take let's say today's base rate's 4.5, we could offer the customer like 4.75 or 4.875. So especially on your lower loan amounts, you get something like 125. The difference in that monthly payment is only going to be about $10, $12 a month, but that's going to create enough yield, enough cash, where the bank can actually pay the PMI up front on the customer's behalf, and it actually lowers the PMI or can get rid of the PMI in its entirety, depending on how that works out. So that's something that a lot of lenders don't talk about as well.
I have another question on PMI.
Yes.
Is PMI guaranteed, or PMI is something you apply for?
PMI is something you technically apply for. PMI is based upon, it's kind of based around Fannie Mae guidelines. So what happens is you get the mortgage, and after you get the clear for the mortgage, then it's sent out to the PMI company. So the PMI is just reviewing that file. I think in my career I've only had once or twice where the PMI company wouldn't insure the file. So that was I had one. It was the bank was cool with it was kind of a double-pronged thing, but the bank, it was a dome house, and the bank was cool with the PMI company. And so, but the other thing is I work with 7 PMI companies. So if PMI company A has a problem with it, I can usually flip-flop it over to PMI company B. Okay. So that's that. New guideline coming down the pike starting next month. This is across the board. I only know one PMI company that won't do this, and I'm keeping it a secret. is that if you have under a 700 credit score, you can't get PMI. Without without a 700 credit score, without the max debt to income ratio is 40%. So if you have over a 40% debt to income ratio and under 700 credit score, you can't get PMI at all. So that might, if you guys have any, on a conventional only loan. So if you guys have any deals in the works right now that are going to be closing after April 1st, make sure you check with your lender to make sure that they're aware of that guideline coming down the pike if the customer has under a 700 credit score, under a 40 debt to income. So that's something new. Conventional, again, goes down to at least a 640 credit score, but really when you're sitting out and pricing out the numbers, typically what I've found is unless the customer has under a 700 credit score, it usually isn't the best financial decision for them unless they're putting 20% down. Because the extra cost of the mortgage insurance and the extra cost of the rate hit for having a lower credit score, there's other options out there. And that typically doesn't make the most sense. Debt to income is all, when we're talking debt to income here on these slides, we're all talking about the back end debt to income ratio. Okay, so again, there's two debt to income ratios. The front end ratio with conventional, they like it to be 29%. In a perfect world, if we're in a black and white world, 29% based upon the person's income for the house, and then the back end ratio, they like it to be 41%. Most lenders will only go to 43%, and Fannie Mae is something that is kind of new to Fannie Mae within the last couple of years. Fannie Mae has brought that back out to 45%, but a lot of lenders won't go past that 43% because that's been the standard for such a long time. And there's an extra hit on the rate. But we'll go to 45, and in some exceptions, actually. What's that?
28, 36.
Yeah, was it?
Yeah. At least you're qualified.
See that back end ratio.
Yeah, I mean, we can actually go up to 57% FHA VA. It's silly, what they do. But also, people don't have any cash anymore too. I mean, 15, 20 years ago, I'm looking back at all my old mortgage books and things. You didn't have 20% down, you didn't buy the house. So that's kind of neat. So that's kind of a little bit about conventional loans. Do you guys have any specific questions about conventional loans? Conventional loans are pretty easy. It's kind of black and white. So once we get into government loans, there's a lot of different subsets. So talking, I guess, let's jump on Michelle's question: bank, mortgage company, that. So And again, I don't work, I've never worked, maybe Nicole, if you want to jump in on this. Nicole worked for a bank for a long time. I've never worked for a bank, I've only ever worked for a mortgage company. It's my belief that a mortgage company has more options because, and that's because all that we do is we can usually do higher programs, higher debt to incomes, higher loan to values. We usually have more niche programs than a bank is going to typically have. And a credit union usually works best if you're, Sienna Moore is doing a little bit better, but put 20% down because most of the credit unions around here don't even do the deal in house if it's not 20% down. They send it off to Homeowners Advantage or Homeowners Choice, which is a mortgage company. So essentially, at the end of the day, they just have a relationship with them, and that's where all the leads come from. Banks are a great option. One of the things that banks can do, there's what's that savings program?
First Home Club.
Yeah, First Home Club. So if you're a bank, you can actually start this thing. You open up a savings account, and you have to put X amount into the savings account. And after a certain amount of years, you can take that, and the bank will actually match that if you meet all the income guidelines and things, and then kind of roll that into it. I mean, you know more about. She works for a bank. I didn't. So yeah.
Well, that's only if they have an association with the First Home, the Federal Home Loan Bank of New York. So there's paperwork and criteria that have to be filled out to do that savings. It's a minimum. Last thing you knew is a minimum of 10 months. The max you can go is 24 months. And whatever bank you open that savings account with is the bank that does have to do the mortgage. So you do have. It can help in terms of if they're needing cash and they can consistently. But that's the catch. They have to consistently agree to put in X number of dollars every month. And if they miss a month, done. So, that's a pretty strict program. The only other, to me, potential advantage with a bank is if there are some unique type properties, banks can portfolio. Because they
I
keep
would
it
agree,
in-house.
yeah. I mean, so, that I would say is the biggest advantage to a bank lender versus a mortgage company lender, is a mortgage company. So right now, we're servicing about 40% of our portfolio. We're a mortgage bank, and we're trying to get to a point within the next 5 years, we're servicing 80% of our portfolio. But a mortgage, like an actual bank, they can kind of turn a blind eye to certain programs if it makes sense, if everything is there based upon that relationship. They're going to put it in their own portfolio. They're typically going to charge a higher interest rate for taking that extra
And
risk.
it's going to be the 20% down.
Yeah, and I mean, sometimes they will make exceptions on
Yeah.
that, but typically it's going to be 20% down. But, banks can kind of bend the rules if they put it in their portfolio, because then it gets back to old school lending. I believe you're going to pay me for 30 years, and I'm going to charge you a little bit extra so we can do that. A bank needs to securitize everything, or a mortgage company rather needs to securitize everything so that it could be sold on the open market as a mortgage-backed security. So it has to fall in between Fannie Mae and Freddie Mac guidelines, Ginnie Mae if it's any kind of government loan. So that's kind of the difference. As far as credit unions go, credit unions are awesome for regular loans, but credit unions, again, with a portfolio, they have that advantage of 20% down. But if you're putting less than 20% down and you're using a credit union, you're actually using a mortgage company. So does that answer your question? Cool. Everybody else cool with that? Cool. Was that pretty unbiased?
That's pretty unbiased. Pretty good.
Pretty good. All right, cool. All right, sweet. Okay, cool. Next slide, Heather. Sweet. FHA. FHA requires a minimum of 3.5% down. You do have PMI, and it is a flat rate of PMI. So that's why FHA works really well for customers who kind of fit into one of three boxes. They either have a really low credit score, they have a really high debt-to-income ratio, or there's just something kind of unique about them, like they haven't been at their job a super long time, they go lax, as far as conventional guidelines go. So as long as there's something a little more unique there, they can make that work. So as far as credit goes, as far as PMI goes, it's a flat rate of PMI. So it's charged 85 basis points. So essentially, if you're buying a really high house and you have somebody that's got a really high credit score, that person, and they have a decent amount of cash, that person's a conventional buyer all day long. But let's say you have somebody that's got 5-10% down, but they've got a 645 credit score. If you price those out, even if that customer puts a 5% down, their payment might be $75 or $100 less a month FHA, because the cost of that PMI is fixed. Where over here, I've run PMI on conventional, and it's been 190 basis points, and over here it's only 80 basis points. Go ahead.
PMI based upon your credit score?
With conventional, it is, yes. So it's, PMI is based upon a couple of factors: credit score, down payment, and debt-to-income ratio. So it kind of fits into a rate card, and then that's how that works. Where with any government loan, the cost of the mortgage insurance is just a flat rate. So with the people that have the lower credit scores or the higher debt-to-income ratios, that's really where FHA works the best. Again, debt-to-income ratio, they are at 55%. The first of this year, Ginnie Mae runs Government National Mortgage Association. Says they run USDA, FHA, and VA. Expanded their automated underwriting systems to allow people with higher credit. Actually ran a VA number through today. Awesome borrowing, 807 credit score, $75,000 in the bank, but he's looking at putting his kids through college pretty soon, so he doesn't want to spend a lot of cash. So he's never used his VA benefit. He's buying a house, and he literally has almost no debt, but he's buying a $270,000 house. So his front-end ratio was 42%, his back-end ratio was 53%. So that's really high, and I wasn't sure if we'd be able to make that work because those ratios were so high. But because Ginnie Mae just extended their debt-to-income ratios, we were able to make that work for that customer. and he's just not married to his girlfriend, and with a VA, you have to be married to the spouse in order to count their income. So that's that. But typically with FHA, they like that front end ratio to be 31%, and with exceptions, they'll go up to 35%. And on the back end, they like it to be 43%, and with exceptions, most lenders will go up to 47%. Again, because we're working actually on getting our Ginnie Mae seller servicer. That's what's going to bring us up to holding a lot more deals in our portfolio. But right now, we can actually go typically up to 55%, and sometimes a few points behind that as far as debt to income ratio. So when does that make sense to a customer? Because obviously we don't want customers buying more than they can afford. We don't want to be negatively putting the customer in a bad situation. But sometimes you have customers, and especially with, and we'll talk a little bit about student loans. So who here has student loans? I've got lots. So any type of government loan, when you're looking at a student loan and when you're qualifying somebody, well, a lot of your customers out there have student loans. And when we're qualifying somebody based upon any type of government loan, we have to use, if they're paying on some sort of deferment program or some sort of graduated payment program, you can't use that with any type of government loan. The Ginnie Mae says you have to use 1% or whatever the actual fully amortized 20-year payment would be, whatever's less. So typically, if you have somebody that's, I've had people that are, a lot of people that are like DAs and people that are doctors and different things like that. They're at a job that in 10 years, their loans are going to be washed away. I'm doing a loan right now for a guy who works at BOCES, and he's an attorney essentially for BOCES, a contract attorney. And he's got $250,000 in student loan debts, and he's only paying like $100 a month on it. But if he was, so he's a perfect example of somebody that makes sense to go conventional. If he was to go with an FHA loan, I'd have to use 1% of that $250, so I'd have to say to have a $2,500 a month student loan payment. A month, yeah. So you have to use 1%. So that's kind of a downside of any type of government loan. So that's that. FHA, we go down to a 620 credit score, FHA. FHA actually will allow to down to a 580 credit score. I don't know any lender that will do 580 to 600. There are, the internet says that they exist, and I've never met one. But we have to believe whatever the internet tells us, right? We will go down to 600, but really it's only by exception. We had a girl that made decent money, but she just had some medical collections, and that's what brought her credit score down. She paid them off, and her credit wasn't going to be fixed before closing, but we were okay with that. So some lenders will go down to 600 with any type of government loan, but typically 620 to 640 is fine. So that's that. Questions on FHA? Cool. So let's talk about Heather's question a little bit. Let's talk about renovation loans. Okay. So when people say 203K, well, I guess let me rephrase. When people say I'm getting an FHA loan, they're actually getting an FHA 203B loan. That is the standard type of loan that an FHA loan is. Okay? FHA loan K is a renovation loan. FHA loan H is a, what do you call it? Right here. Natural disaster loan. So there was a bunch of those done this year with all the hurricanes and everything down south. So you can do, so there's different subsets of the FHA type loan that have different product guidelines. The FHA 203K loan, so did you have a specific question on that?
No, just like run through like briefly how the process from start to finish, just a short.
Got it. So,
because I know I've been through it long.
Put me on a timer. No, so yeah. So a renovation type loan, essentially what you're doing is does everybody know what a renovation loan is?
Yeah.
Okay, cool. So essentially the process for a renovation loan, you make an offer on the house, on a fixer-upper house or a decent house that just needs some nice renovations. You get the HUD consultant to come out. The HUD consultant, once the offer's been accepted, will do what's called an SOR, specification of repair. That SOR goes to the appraiser, and the appraiser says, hey, the house is worth X, today, but with these repairs specifically being done in the specification of repair, then the house would be worth Y. The house at Y needs to appraise for at least that amount. Okay? We lost one the end of last year because it didn't appraise for that amount. You know, the guy was buying the house for like $40,000 and wanted to put $40,000 in it, but at the end of the day, it was still only a $70,000 house because it was 750 square feet. So, you know, so that one, you know, was that. But, or in that scenario, the customer could bring that extra cash to closing to make it work, you know, above and beyond the appraised value. But typically, what you're going to see is, you know, that the value is there in most houses. So we get the appraisal back with the SOR, with the appraised value. We at our branch, and I'll talk specifically how we do it, so we do the income asset portion, and then Jim and his team does the credit portion, gets the contractor all certified, and gets everything all set, and then we close. At the closing, we close as is today on the property, and then that's when the work starts. And they have up to 6 months to get that work done. Okay? And then the HUD consultant's coming back managing the project, and depending on the size of the project, the scope of repairs that are being done, it all depends on the draws and everything else. Our biggest, nicest one that we're doing, what was the one that, everybody probably knows this building, was it East Hill, West Hill? West Hill, 32, everybody knows 32 West Hill.
Oh, yeah.
So I've actually talked to this guy about his house, because to ask him if I could tell everybody about his house, because everybody knows it, one, because I've been off the market for my house. Exactly.
It's supposed to be a house, yeah.
So he bought that house for $45,000, I think it was, $50,000, somewhere in that neck of the woods. He's doing $100,000 in repairs, and that house appraised at $250,000.
You got a lot of square footage there. I mean,
Exactly. Yeah, he's coming in, that whole ceiling is gonna be V-groove, it's gonna be gorgeous. But that's a perfect example. He's gonna move into that house, and he's gonna have $100,000 equity day one. That's what that loan is made for. I mean, people do it for foreclosures, they do it for different things. HGTV rules, who's ever seen Fixer Upper? So I'm a mortgage guy, I'm like, how are they paying for all this, right? I find their loan officer that's on their website, and he's a 203K specialist. That's all they do, all of those are renovation loans.
Nice.
So they're buying the house, putting the renovation in. Most of the houses aren't foreclosures. Yeah, I love Lucy Kitchens, you know, and they need the work done. But, and this is the issue. Now, we're starting to get some appreciation in our area where you can actually do that. 5-10 years ago, it was really difficult to do that here in our area because you couldn't put the cost of construction. You'd have to buy the house at such a deal with that cost of construction to make it work. Now you're starting to see that works, and you know it can actually appraise. And we've run these scenarios. We run a ton of these scenarios for people. Now that we've been advertising, we've been doing them. A lot of people have been sending us renovation loans, and we've been helping a lot of people do them. But it's an awesome product for people. So that's a quick 5-minute steal on that.
Can you tell us the next day, or is there a rule they have to live in there a certain amount of time?
I mean, theoretically, I mean, so with an FHA loan, it has to be your primary residence. You technically could sell it. There's no way that would stop you from selling it. But yeah, it's supposed to be your primary residence. So.
My question is, how are you doing with the foreclosure side of things? Are you doing 203Ks with foreclosures?
Yeah, close as is on time is how we're at.
Okay, so doesn't matter. You're doing the construction based on we probably need water, we probably need furnace, we probably need.
Correct.
Okay.
Yep.
And either part of the scope of repairs is what if they think the furnace needs to be repaired, but automatically when you're doing a 203K, they're adding in a 15% contingency.
Okay.
And that's an automatic if there's no power, no water on.
Okay.
So that's built in case there's extra issues.
Because a lot of the banks aren't willing to.
Well, because it's not going to meet guidelines for appraisal either.
Right.
Those aren't on, but that's the thing with the 203K. It's pretty much assumed that it's not.
Right.
And that's what the contingency is there for.
Fabulous.
So at the end, can you lower the loan amount if you get a nice surprise and the furnace works and there's
You can do two things with that extra cash. Okay, you can take that cash and lower the loan amount, pay it down. So let's say it's a $200,000 total cost of the project, and there's an extra $15,000. You can lower the loan to $185, Or you could do a change request and say, instead of putting Formica countertops in, I want to put granite countertops in, you can reutilize that cash for something else. Instead of doing steps off the back, I want to do a nice big deck, something like that.
It's not going to change the principal and interest payment because that's already set by the loan, but it's
Because you
going to be a
closed
principal
already.
reduction.
Yep.
How long are they taking to sell or close on renovation?
About 60 days.
Really?
Yeah.
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 Again, with foreclosures, when you're dealing with banks,
Yeah.
they want it at 45. Usually it's our contracts are coming in at 45. And when
The
it's
first,
one
the first
concession.
few we did were taking a little bit longer, and we did lose a couple with those, but it wasn't getting the contractor set and doing everything else. It was, we were having some problems with the consultant, not doing things in a timely fashion. And because we weren't getting things, we couldn't do our part, so that's why we kind of went around and now we have a different consultant.
And who's our consultant now?
His name is Brandon Bruce. He's a consultant for Friends of the North Country, and down in Keysville, and he's been a consultant for them, and now he's actually a HUD consultant specifically for renovation loans as well. Yep.
So you would have him come out rather than a home inspector?
Correct. You could have a home inspector first, kind of give you an idea, but essentially at the end of the day, I would just have him go out too, and he can inspect the house and, kind of point out the issues if you know you're going to do a renovation cost. Or do a renovation on there, and you just have them charge you for a home inspection. So let's say a home inspection is $300, and then the total cost of the HUD consultant work is $900, and you decide to move forward with that house, and then you do want to do that renovation loan. What's that burn on? Is it Brandon Powell Road?
Yep.
Yeah. I know there's been a couple offers in on that place. We were going to try and do a renovation loan on that, but when the customer went out, initially what the customer thought it was going to be to what it actually was, because it was a burnout, was actually quite a lot more than it was worth. So it didn't make sense for the customer to do that.
When does the consultant get paid in this process, and by who?
So the consultant gets paid up front. So the consultant gets paid twice, always by the borrower. So they get, for that initial report, they get paid for that report. So it's a very detailed report. I mean, that's actually, depending on the scope of work, it's a home inspection, but literally cost of materials, where they're going to get the material, what the actual spec of the product they're putting in. So that way when the appraiser sees it, when they say French door, they don't, it's not like a cheap plexiglass French door, or, like it's a double wide, but they know it's going to be a Anderson, type door, so that they can kind of judge the quality that's going in. Then the HUD consultant gets paid after the fact, and that's built into the closing costs with each draw. So each time he has to go back and do a draw inspection, per the amount of renovation, it judges how much each one of those draws is and how much he gets paid.
So where does the timeline go from purchase offer, acceptance of the purchase offer? Where does the HUD guy come in to play there?
Just like you would with a home, I mean, you could have him come in before, but just like if you were selling a regular house, would you have the home inspector come in before you had a purchase price negotiated? Probably not. Okay. You may want to in one of those scenarios, but if you did, it would be like you were having a home inspection before it was done to get that opinion. So that first initial portion of it is like a home inspection, in that he's going to come in and tell you exactly what's wrong with the house. And he's going to give you kind of a ballpark idea of what it's going to cost, but then he's got to write up that report, and that report is the other portion of that. Is that other $400 or $500. Lisa.
So that brings another question, I'm sorry, is if they were to do that prior to the contract, that would also allow them to not have to have a New York certified home inspector to get out of the contract.
In order to be a HUD consultant, you have to be a New York certified home inspector.
You do? Okay. Very good.
So that's what my question was. So the person that does this scope of work,
Yeah.
they come up with, I don't know where they come up with figures, okay? But, are they using those books for electrical, we were talking about some unit there, electrical, so much an hour, to come up with a scope of work, and then what if you decide to do less? Is that where the appraisal came in as a problem, or when we were talking about another one?
Yeah, so as far as where they're coming up with that, I assume they have some sort of program that says, the average labor rate is X, and, this is that. What would be my assumption, I can't speak specifically to that, I don't know if you can. But that would be my assumption, because there's just so many things that I think you'd have to have some sort of program.
I mean, that person that goes there is gonna pick everything that's wrong with the house, correct?
Correct. Well, he's going to say, so this is what, and this is
No.
where we've run into issues before,
Right.
is that because the current consultant that's been out and done a lot of work says all of this needs to happen, but it doesn't. All of this needs to happen to meet the HUD guidelines.
Right, we need to
Make it happen.
Exactly.
Well,
And
FHA, but it has to reach FHA
FHA
guidelines.
guidelines.
So-
Just like it would be if it was a regular stick-built house, it has to meet those guidelines.
Yeah.
Exactly. Yeah, the roof has to be, can't be within the last couple of years of its life expectancy. It has to meet regular HUD guidelines. You don't need to go above and way above and beyond. You can. You have the right to, as long as it appraises.
Your money.
Exactly. And that's kind of where we've butted heads with the current consultant, and why this new guy is kind of stepping forward. So.
Is it true that it has to be a contractor, it can't be involved doing the work?
So you have to have a licensed contractor, so, kind of. So you have to have a certified licensed contractor saying he's doing the work. However, I've had a lot of these scenarios where the borrower is very handy, or the borrower knows the contractor, and the borrower is doing a ton of that work. And let's say it's a $50,000 renovation budget, and that borrower puts a lot of his sweat in over the next 6 months, and they're able to take that $50,000 and get the project done for 40. And it gets back to the scenario where we were talking about with Chris. So then you get this extra 10 grand. Well, we can throw that into more material, or we can throw that right down the principal house.
Can you go on a cruise?
No. Unless you invite me, then I'm sure we'll fix it. Cool. All right. That's it about renovation loans. Any other questions?
Yeah.
Cool. Not as long as I thought. Well, we could certainly do a whole class. All right, cool. Next slide, Doug. VAs. Who here's done a VA? Purchase house and VA loan? Cool. But basically everybody? Okay. Awesome. So, a lot of people have this idea that VA is this the VA inspector is so hard and is super intrusive and it has to be all these kind of. It doesn't. I mean, yes, it does come down to the appraiser's specification, and it has to meet what the appraiser says is the VA guideline. However, it's not really that much different from an FHA loan. You can't have peeling paint. You have to have a handrail. The roof has to be within the end of its life. That's one of the biggest things I hear about VA loans is that the house has to be this meticulous house. And I mean, it can't be a shack, that's falling in on itself. But it does have to be structurally sound and everything else. But it just has to be it doesn't have to be the Taj Mahal, I guess is what I'm saying. So, yep.
I guess my question to that is, though, why VA versus FHA?
Because
if you had someone qualified for both, why would you do one versus the other?
No PMI with VA. 0%. It's 100% financing with no
But I thought the
PMI.
interest rate was higher.
No, same as FHA.
There's a fee, though.
What's that?
There's a fee.
There's a VA funding fee
Yeah, VA
if they're not exempt. So they might be exempt. So if they're disabled, depending on their disability, they might be 100% exempt and not have a funding fee. Okay? So the fee is 2.125%. So yes, there is a funding fee. That's 2.125%. So let's say that, let's just use round numbers. Say they're buying a $100,000 house. Their mortgage amount would be for 125. Yeah, 125. Sorry. Anyway, so that's what their mortgage amount would be. The cost of PMI on an FHA loan would be 85 basis points. So 100,000 divided by 85 would be like $78-ish a month. Okay. The extra cost to finance 2,000 is going to be about 4. So it makes a lot more sense to do that. Yes, they are paying a fee, but they're financing it, they're rolling it all into closing versus paying that monthly premium. So that's why the VA loan makes a lot more sense. Also, it is 100% financing. You don't have to put any cash in.
Right, I just always thought the interest rates were higher on a VA versus an FHA, that's not true.
FHA, VA, and USDA typically all have about the same interest rate because they're all traded on the same coupon.
Okay.
Yeah, they're all, because it's based upon a Ginnie Mae coupon. So rates are based upon, we talked about rates a little bit. So rates are based upon the coupons that are being sold on the open market. Coupons are bonds. The most traded bond is a Fannie Mae 4-year percent coupon right now. A couple months ago it was a 3.5% coupon, but as interest rates have risen, investors have liked the 4% bond because it's yielding more cash for them. So that's kind of why you've seen this increase in interest rates over the last little bit. But yeah, any government loan is traded on the Ginnie Mae bond, so they're all right about the same interest rate.
Okay.
Okay, cool. Cool. VA, 100% financing. You can put money down on a VA loan, but I usually look at it and look at the customer's whole profile. And if you're putting money down on a house, for every $10,000 extra you put down on a house, it only lowers your payment by about $50 a month, depending on rates and everything else. So let's say the customer has a car payment that's $350 a month, and they owe $8,300 a month. Well, if you can take that same 10 grand that you put down on the mortgage payment, it's only going to lower your monthly payment by $50 a month, or $45 a month. Or if you can get rid of that extra cash flow and create an extra $300 of cash flow for the customer every month, it's that's gone and that helps them. So, what Nicole and I do with my team, and kind of what we've done is not financial planning for the customer, but really kind of looking at it from all points of view and really trying to get the best benefit for them long term. VA will go down to a 600 credit score, but the automatic underwriting I rarely see, unless they have substantial reserves, I rarely see get accepted past a 620. So that's that. They do allow for a higher debt-to-income ratio. The VA is a little bit more finicky, though, than FHA. We had a customer a couple months ago that had like a 650 credit score, and their back-end ratio was at 47%, and they wouldn't accept that. The VA wouldn't accept that because they had some blemishes on their credit report in the past. So with the VA, the more blemishes, the more credit problems the customer has had, the closer to the guidelines it gets a lot faster. Yes?
Some buyers think that they can only use their VA mortgage once.
That is incorrect. You can use your VA mortgage once with the regular funding fee. Okay? So I've had customers, you have to re-up the funding fee. So where that becomes a problem is if the buyer is going from a VA loan to a VA loan. Okay? So they're selling a house and they're moving into the next house VA. Unless they're buying smaller houses. Okay? I won't do the calculation now because it's something I barely understand and do an Excel spreadsheet to figure out. Actually, Jim, you might even know a little bit about this.
Well, I think one thing with the VA is if you sell the home to somebody who has a VA loan, then you can reuse your eligibility.
That's part of the equation. Really what it comes down to is the VA, you have a certain amount of guaranteed entitlement. So, and it's all based upon county limits and everything else. So in our county right now, it's $272,000 is the VA county limit. So if you had a house, so basically the easy way to do it, it's not exactly accurate, but you can borrow up to $272,000. So if you had a $100,000 house and you're moving from a $100,000 house to a $150,000 house, then that would work because you're not using your total amount of entitlement. Let's say you had a $150,000 house and you're moving to a $200,000 house, you wouldn't be able to do that. You would have to kind of stagger that closing because you would have to have the VA re-up that entitlement, which takes a week or two. So that's kind of how that works.
Okay.
Make sense? Cool. And then the second time, because it's not their first time, it's I think it's what, 3.25 is the funding fee. So the funding fee is a little bit more expensive if they're using it 2+ times.
Funding fee, so they have to come.
No, you're financing that. You're financing that in, yeah, exactly. But the VA charges a little bit more for the second, about a point more. Cool. Okay, cool. So that's VA. USDA loans. Who here's done a deal with a USDA loan before? Basically, anything outside of the city of Plattsburgh qualifies for a USDA loan. Actually, can you make a note, and I'll send everybody the map. Essentially, where it is it's Scomotion Creek, just north of town on 9, to the highway, then the highway down to Tom Miller Road, Tom Miller Road out to the turnpike down to Ruger Street down to the highway down to South Junction Road, and South Junction out to the lake. So essentially, it's the city. There's not a ton of houses in that little Tom Miller Road out to Ruger, but in that neck of the woods and then Cliff Haven don't qualify. Everything else qualifies for a USDA loan in our town. And until you go over to Watertown or down to Glens Falls, those are the next closest areas that are not qualified for USDA. So essentially, anything outside of the city and Cliff Haven are going to qualify for USDA.
What did you just say about Cliff Haven?
USDA does not qualify for Cliff Haven. It is 100% financing. It does have a funding fee similar to VA. It's not quite as expensive. It's 1%. So what you're doing there with a USDA loan and on a $100,000 house, your mortgage amount would be for 101. So let's kind of talk FHA versus USDA. If you have the same borrower that has let's say a 700 credit score, and he's going to buy a, let's use round numbers, a $100,000 house, and he's putting down 3.5%, so the mortgage amount's $96,500. And then you have a second borrower that's buying that same $100,000 house USDA, but they're increasing the finance fee to $101,000. Who has a lower payment? Raise of hands if you think the FHA person has a lower payment. Raise your hand if you think the USDA guy has a lower payment. Okay, 3 people raise their hands. Let's play this game again. So the USDA person on a $100,000 house, because of the cost of the mortgage insurance, the person with the USDA has their payments on a $100,000 house is $45 less a month, and they're borrowing more money. Okay, because with USDA, they don't have a standard PMI policy. It's all backed by the government, and they pay what's called a guarantee fee. So instead of 85 basis points like they're paying with FHA, they're paying a small upfront cost, which they're financing into the mortgage, and then the government's only charging them 35 basis points. So that extra cost makes the payment a lot less. Does that make sense? So they're putting no money down, and their payment is cheaper.
Yeah, and the so it's like 103 or 102%.
101.
101.
It used to be 102.5.
Yeah.
They lowered it last spring to 101.
Okay.
Yeah. Cool thing about USDA that not a lot of people know, you can actually finance in the closing costs. Not a seller concession, but let's use this $100,000 example. That happens with a lot of USDA deals. So let's say they buy the house at 100 and the house appraises at 120. You can increase the loan amount to bring in all of the closing costs. The borrower is literally bringing $0 to the closing table. So you can increase that $5,000, $7,000, whatever it is, the taxes, the first year's taxes, the first year's insurance, everything, as long as it's underneath that total appraised value. It's the only type of mortgage where you can do that. So a lot of people don't know that. So that's kind of a neat thing. Is there a question? No? How's the food? Cool. Is this a better venue? Yeah. Cool. We talked about the guarantee fee. USDA does have a 640 minimum credit score. So if you have a customer, unfortunately, I've had customers that are at 645 and then they went and had their credit checked because they wanted to save 5% at Target. They didn't get a card, but that extra thing lowered them down and they're at like a 638 at closing. That's a problem. So, if you do have somebody that has a lower credit score and they are going with a government type loan like that, make sure they don't have their credit. Make sure they're doing everything correctly. Because that could become a problem. And they do have a more conservative debt-to-income ratio. It goes off the conventional loan debt-to-income ratios. So they max out at 45% on the total debt-to-income. So that's that. Questions about USDA loans?
There is an income limit on USDA.
Yes. Income limit was $76,000. It's just been increased to $78,000 and change.
It's based on family size, though, right?
It is. So that's a 1 to 4 unit family size.
And then 5
If you have more than that, God bless you with that many kids. No, but if you have 5 to 8, I don't know the guideline off the top of my head, but I think it's 5 to 8 is the next unit size. I believe it's 106,000 is the total income limit. So if you do have a bunch of kiddos running around, that can help.
A friend of mine had 5 kids, and she did like a $290,000 mortgage on the.
Yeah.
Right.
Yeah. Because the total income has to be under 106,000.
Yeah.
So an income of 100, an income of 100,000 would support a $300,000 house if they didn't have a lot of debt.
So does the first payment before starts?
One more time, please.
Does any of those first payments go towards principal, or do they all paying off that?
Just like a regular loan, you know, I mean, all your interest is front loaded whether you're buying a car or a house. Yep. Emily, did you have a question?
Yeah, was there a limit on the price of the house for USDA?
There's not an income limit on the price of the home, but there's an income limit on the individual person on their personal income. So somebody, and if you're a 1 to 4 unit family and you make 76,000, you're really going to top out at about 180,000. You're really not going to be able to afford with those debt to income ratios more than a $180,000 house. Okay? So that's that. Questions with USDA?
Questions in general, like what are you requiring for USDA, FHA, VA for water testing, things like that?
Great question. So if it's just a regular well, we need a 2-part water test. If it's either a hand-dug well or any artesian well, it's got to be the 4-part water test. If it has a septic system, we require for any of our government loans that basically the liability is passed. So we don't need a full dye test done. We essentially either need a septic company to just look at the tank and say, you know, we inspected the tank and it's a 100-gallon cement tank and it's in good and working order. 1,000 gallons. On my toes.
You are in trouble.
I don't think I could support 100 gallons. I would fill that pretty quick. Cool. Cool. Other questions? Okay. Questions? Cool. So let's kind of get back to everybody's questions here. So what do we do if they don't qualify? Now, as far as this goes, and I apologize, I forget who the question was, but I'll tell you what we specifically do. We try and coach the customer to figure out what it is they need to do so that they can qualify in the future. A lot of people come to me, that's one of the reasons, you know, people, let's get back to the mortgage company question, you know, that people, you know, I know come back to mortgage companies is, you know, and I can only look up to ourselves here, you know, to me it's like, kind of like planting a seed. If I can take somebody under my wing, show them what they need to do to fix their credit, what they need to do to position themselves so that way in 3 months or 3 years or whatever it is, they can fix their credit, and then they come back and they can buy a house. That is one of the most rewarding things that I've done. You know, I mean, it's cool that, you know, anybody that comes in, they've got all this money in the bank and awesome credit and everything, they want to buy a house, great. But somebody that doesn't quite qualify and just needs to be shown the path to do that, I get a lot of personal fulfillment out of that. So that's what we specifically do. You know, if they don't qualify for other reasons, we follow up with them. Often we have a CRM that we use, and you know, we follow up with them continually. So that's that. Are we doing double wides? Yes, we are doing double wides. So we ran into an issue last year with where our double wide lender said we don't want to do business in New York State anymore. And earnestly, our double wide lender was kind of a pain in the neck, so we didn't really want to do a ton of business with them either. We have a new double wide lender. Their ratios aren't, they only take good loans. That's essentially what it comes down to. Like, if it's somebody with you know, going FHA with a 642 credit and no money, they're borrowing every penny there, I'm not going to be the best person to get that deal done for you. The rates are awesome, which is nice. But if it's under a 680 credit score, right now it's not something that we really, you know, have the avenue to do. How can you buy? This is not just me, this is any type, any lender. So with new construction, you can only, in New York State, you can only get a USDA loan with a new construction on a double wide. You can get a double wide with a VA loan, you can double wide with an FHA loan, you can get a double wide with a conventional loan. And every lender is kind of different in that. We are doing 5% down conventional, 3.5% down FHA, and 100% financing on our double wides. So that's that. Questions on those? Cool. Awesome. How to apply for a mortgage? We'll just have your customers give me a call. So essentially kind of how our process works in a perfect world is the customer calls in, we get a little bit of their information, and then Heather's going to set them up with a time to either meet with myself or Nicole sometime within the next 3 days. I want to sit with all of our customers within 72 hours, and that's if they're not making an offer right now. If they're making an offer right now, we'll do it over the phone. I prefer to do it face-to-face. I think the customer gets a lot more out of it, and we can really, by them bringing their documents in, we can collect all their documents, make sure they're good, and we can kind of underwrite a lot of those issues out of the file now. There's a lot of, in our process, there's a lot of things that we have the borrower sign just so we can take care of future problems. Having them sign a borrower cert, which allows us to verify their employment. Having them sign a Social Security authorization so we can do all of those things day one, and which allows us to move a lot faster. We collect their documents, we look through their bank statements to make sure there's no large deposits, and look for a lot of those potential problems day one when they're applying for a mortgage. So then they're going to come in, we're going to go through, we're going to take a look at pull their credit, see where their debt to income, make sure we can count all their income, and take a look at their whole picture and say, hey, these are your types of loans. There's conventional loans out there, FHA loans, USDA loans, and VA loans. And then kind of figure out from there which one's going to make the most sense for them based upon cash and credit, typically. So does that answer the question on how to apply for a mortgage? Cool.
What's the minimum documentation you want them to bring?
I mean, we can do it with nothing, but when you call me and ask me how qualified this customer is, it really what it comes down to is that. If I have a customer that brings me all of their documentation, I can send it in. I can actually have the whole thing underwritten, so that customer isn't just a pre-qualification, he's an actual approval. It's been guaranteed by underwriting, and that's what we're trying to tell our customers right now, is bring all your documentation in. There's almost every deal is a multiple offer situation, and if you have more than a pre-qualification certificate, when you're making that offer, it makes you stand out that much more.
Can you send us a list of the documentation that they would use?
Certainly.
Yep.
Yeah, I mean, I'll go through that right now, but essentially we need driver's license. I'll have Nicole send everybody here. But we need a driver's license, Social Security card, your last month's worth of pay stubs, your last 2 months' worth of bank statements, your 2016 and 17 tax returns and W-2s, and any type of retirement statements that you may have. And that's, without getting into unique situations, that's the basics. If they've been divorced or separated, we need to verify those things of that nature. If they have a business, there's other things depending on the type of business and how it's held, other things that they may want. So that's that. Cool. How is interest rate determined? Interest rate is determined by the open market. How much are, and I talked a little bit about earlier about how bonds are traded. That's how interest rates are determined essentially, and how all banks borrow money that we're turning around and giving to your customers. So that's how the interest rates are determined. There can be fluctuations per the different programs. Typically, all your government loans are going to have a little bit of a cheaper interest rate than your conventional loans because they're backed by the government. Conventional loans are usually about an 1/8 to 1/4 of a point higher as far as interest rate goes. And then it comes down to rate adjustments with credit, debt to income, and loan to value. The rate adjustments on a conventional loan swing a lot more than they do with government loans, because with government loans, I joke they screw everybody equally. So it's there. The rate adjustments are a lot smaller. With the conventional loans, the rate adjustments can swing quite a lot, especially if you have low credit. So that's kind of how rates are determined. I'll jump in here a little bit. Forecast for rates this year. Rates are going up. If do have customers that are on the fence, and rates are going up. We're kind of in this unique world right now. So again, it's all based upon bonds and how bonds are being sold. Who's the largest buyer of bonds? Any guesses? No. The federal government. The federal government has been buying $86 billion worth of bonds every month since 2009. They've said we're going to stop doing that. We're going to ease our way into that. And every month we're going to buy $5 billion less. Okay, they made that announcement at the beginning of the year this year. So what we're seeing is that we're seeing the largest buyer of bonds say, hey, I don't want to buy anymore. So that's one factor. The second factor is people are scared of inflation right now. Okay? Inflation's on the horizon. Rates shouldn't be this low. They shouldn't have been this low for this long. The last time we dealt with a recession type thing was, when rates jumped up to, in the mid-80s, jumped up to 10, 15%. That's what should have happened in the last decade, and it didn't. So because of that, there's a lot of inflationary. People are scared of inflation right now, which kind of gets to our third point. Who is the second largest buyer of bonds? Any ideas? Foreign governments. Exactly. Now let's say, and I'm not very versed in the bond governments of, the bond returns in China. I am very versed in the bond returns in Europe. If you bought a bond in Germany and you bought a $100 bond, next year when you pulled it out, it'll all be worth $90. This year, you had a negative return right now. So we actually have a pretty good return, at 3%, 4%. So that's awesome. So why are they stopping to buy? They're stopping buying our bonds right now because they're scared of inflation. If we run into inflationary issues and they take their money and they buy our bonds, when they go to cash their bond out in a couple of years and our dollar is worth less, and then they have to do a currency conversion back to their dollars, they have a net loss of money. So with inflation's kind of a two-pronged thing. A lot of U.S. investors are stopping to buy, but more importantly, foreign governments aren't buying our bonds anymore. So you're kind of seeing this perfect storm of the three largest buyers of bonds stopping to buy bonds. All the meanwhile, kind of Mortgages 101, the stock market's, crushing it right now. Okay? If I'm an investor, just today, I got an extra $100. Well, if I put it over here, I'm going to get this return. If I put it over here in this pile, I'm going to get a bigger return. Most investors are throwing it in the stock pile. So because there's less people buying and how supply and demand works, that cost, because the demand's going low on that, there's more supply and the cost of that increases. So there's this perfect storm, and different analysts are saying different things. Right now rates are in the mid fours, depending on where you are. We've actually had a couple lower credit customers and that we've priced out that have been in the fives. But right now, analysts are saying that by the end of this year, the prime rate is going to be 5.5% or closer to 6%. So rates are rising fast. Which gets into an issue, and I dealt with an issue like this week. I had a customer that didn't want to close until June. Well, if you can only lock the loan for 60 days, I don't know where the market's going to go in the next month. So that's something that we need, that you guys, when you guys are out in the field thinking about, there might be a better way to negotiate that. So that particular one we did is we did it now, we're closed in 60 days, and we're going to do a rent back to the current owner until they can get out. So that's something to think about in the field, because with rates increasing this fast, I have one that we're dealing with a renter. If we don't, this was actually an APA issue. It's an APA issue, and we're waiting on the APA. If the rates go up over a certain amount, she's not going to qualify to buy the house. So exactly, yeah, because the net income. So that's something else to think about, especially in a quick rate moving environment. What's the best product for the customer? And we talked a little bit about that. Really what I do is I take a look, I show customers all their options. We're initially going to kind of weed out. Did they serve in the military? Okay, well, that's not going to fall. And then we kind of look at their cash, their credit, and everything else. And I usually, when Nicole and I are talking to customers, I put at least 2 or 3 options in front of a customer and make them make the determination. Because I ask them pointed questions so I can really figure out what their needs and wants are, and then from those needs and wants, we can figure out which program is going to be the best program for them. Make sense? Cool. Appraisals, home condition. So, obviously we know appraisers determine value of homes, but with any type of government loan, or even conventional loan in some instances, the home has to meet certain conditions, okay? And it is the appraiser's determination of that. Now, how that works, let's just talk FHA. FHA has a 2,000-page book that determines, that handbook that determines what is an acceptable house. And every appraiser has a different determination of that book. There's certain appraisers out there, and I won't name any names, that take everything very quite literally and in that book, and may want to go back out to the property 2 or 3 or 4 times.
For $100 each time.
Exactly. So I don't have those type of appraisers on my docket because I don't want that for my customer. But some lenders do. There's one lender that I do a lot of business with. I only have a few appraisers on my docket. I've kind of selected the best, and you have to have at least 2 appraisers, so that you're not giving appraisals to every business or to one specific appraiser. I have 2 that I primarily use. There's a third one that does a little bit of work for us, but not often. But my main appraiser basically said to me, Adam, I look at it, is the home safe for a toddler? Can a toddler go in this house and not hurt himself? Can he walk down the stairs and there's a camera? If the house is older than 78, is he going to eat the peeling paint? Is there a railing on the deck? And that was probably the most common sense answer that I've ever heard to that question. So I can't talk for every appraiser because every appraiser is different and every appraiser's opinion is different. And unfortunately, we have to go by opinions with appraisals as it relates to home conditions. But, and I'll talk to my appraisers. My appraisers are pretty common sense, and we've had issues where I've called the appraiser up and said, well, really? And they're like, okay, well, don't do it like this, do it like this. So there's again, it comes down to opinion, so it's really hard to, put a broad scope on that. And again, I can only talk to the decent appraisers that I have, but with my vast experience that I've done with working with a lot of different appraisers in this community, I personally have chosen who I think to be the best. So I don't have other issues.
You want to give us those names?
No.
Send those to me.
What's that? Professionally, I don't think we should be naming names. I've not named any names today.
However, if they send your to us, we guarantee that they'll be one of those 3 appraisers.
And if you've done any amount of business with us, which a lot of you guys have, you know who those appraisers are. So that's that. Cool. And we talked about banks, mortgage companies, and credit unions, and time frame of closing. We really got our system down. We can close loans in 25, 30 days if we can get title done sooner. That's really the big caveat for us. We've closed a VA loan in 23 days.
Wow.
We've closed an FHA loan in 17 days. We can close loans fast because we get everything up front. We talk directly to the underwriters. My processing is in my building. I do loans fast. Usually what we're sitting around, I send out bi-weekly updates, my team does, and it's usually waiting on title, waiting for the appraisal, and or getting documents back from the customer. So what we've done about 2 years ago, I added an extra step in my system to sit down with the customer at the very beginning of the process. We have an email, kind of a canned email that goes out, and then I have a secondary conversation with them that says, you are a member of my team. And the slower that you get documents, if somebody on my team says, I need something from you, don't argue, just get it. We're not here to make your life worse. We're all on the same team. We're all working together here. And we're trying to get that. If we have been asking that customer for something for over a week, and we can't get it, and you're the agent, the buyer's agent on that deal, I'm going to call you, or my team's going to call you and say, I need your help. our customer isn't cooperating. Now, it might be that they requested their deferred comp statement to come in and that takes 2 weeks to come back. That's not the conversation I'm talking about. It's, I need a bank statement. Could you just have them go to the bank to give me a bank statement? I had a guy, we're currently working with a customer who says, Adam, I would really love to, but I'm really stressed out. I'm working 30 hours a week.
Wow.
Exactly. And your excuses. But I mean, but what I've realized is by having those conversations up front, by doing more work up front, we can meet all those things. The biggest thing that I'm running into is title. I was actually talking with Gina over at Brian Snell's office today, and one of the things that we were talking about doing was having her come out to help with give one of these presentations to say, hey, when you're listing homes, when you're talking about homes, what can you guys do with your sellers to make things go faster on those whole transactions?
Mm-hmm.
So something else I was thinking about for later this year. You guys think that's a good idea?
Mm-hmm.
Yeah. Cool. Awesome. Cool. So time frame of closing really just comes down to title 80% of the time. But you know,
what's the trigger for the attorneys to order title?
Depends on the attorney. Some attorneys want a commitment letter. Some attorneys want essentially a clear to close pending title. Some attorneys will do more research, and that's why I use some attorneys, prior to and try and track down your seller's title, because there's, what, 4 abstractors in this county? And if they've sold their house in the last 15 years, one of those abstractors probably has the back title.
Right.
So, you know, that's one of the reasons I do the majority of my business with a specific attorney, because their team looks for the title. And that makes the whole process faster. And finding that back title work is usually the biggest component. Or if they don't have the back title work, tell the attorney so that they can order the title. Because it doesn't matter if you're ordering it day 1 or day 45. Getting that title done fast is usually the better issue. I know one of the things that, you know, Gina, the conversation I had with her this morning, one of the biggest things is on the listing side for you guys, is make sure when you're telling them what their address is, one of her biggest pet peeves is when she gets the wrong address for the customer. That she sends them something, they have the wrong address, it comes back. So now they just wasted a week and a half waiting for the mail. You know? And I didn't even know that was a problem. You know? She's like, that's one of her biggest pet peeves. So I will get her in later this summer so we can, you know, sit down and talk about things that you guys can do when you're listing agent and buyer's agent to help speed up the transaction. Because there's it's one of my favorite drugs. I went to a graffiti course at one point, and in all transactions there's this graph. Okay? And this is love, and this is time. People go under contract, woohoo! Everybody's super happy, everybody's super happy. I gotta spend some money, you know, different things, my closing costs are what? You know, different things, oh, cool. Hey, we got the appraisal in, awesome, cool. And we'll just keep going on down here, and at some point, there's a little line called hate. And the whole point is to try and close here. Because here, that customer's gonna refer both of us. If they go here, they never go. Now, everybody's hate line is very different. There's some customers that's up here, and there's some customers that's down here. But that's a really simple graph that I saw once. I thought it was really comical, but very, very true. And I have spent a lot of time, I've had a lot of conversations with a lot of people in this room on different ways that we can do different things to speed up transactions. But title is usually the thing that drags on closings the longest.
We could just get the attorneys on board to order it as soon as we get in the contract.
But they won't.
That's a different conversation.
But if you change, if you say to your seller, maybe update it now, if it falls through, it'll be that much updated for the next buyer.
I found a title company that would be willing to do it out of Saratoga that would come up and just order your title search on everything day 1, and I could close loans in 25, 30 days. The problem with that is the extra cost to the customer is $800,000. And when you're dealing with purchase prices this small in this area, it just doesn't make sense. So, cool. Was this a good presentation for you guys? Cool. I hope you guys all enjoyed lunch. If there's a little survey there, if you could just take a few minutes, it would really mean the world. And